Good morning, everybody. This is the live market open for Wednesday, July 27th. I'm Yohay, Elam of Forex Crunch, doing this show as usual, and Market Movers podcast, doing the show as usual for FX Street. Hi, everybody. Idinda, hi, Ed. Today, as usual, we're going to talk about recent developments in markets, talk about various charts and levels, and do several special segments. So we'll have a preview for today's big event, Federal Reserve. GDP preview, more focusing sort of on generally what this means, an update on the US elections, which are becoming very, very tight, and the next 7 days, the next week, as usual, we do a preview for the next week. As always, your questions are more than welcome. If you cannot see for any reason the chat box under or alongside the screen, the video, please go to the address here, tlk.io/fxrate-forex-live-video. Okay, what's the mood in markets? Well, in general, I would describe it as mellow. It's not terrible, okay, but it's not really positive. We had last week's Donald Trump's acceptance speech. It was 90 minutes long, and it contained lots of doom and gloom. I was surprised because the Americans I know are optimistic, have sort of a can-do approach, and Trump was talking about how terrible things are. And I think that also has some impact on markets. More importantly, we have oil prices falling. There's just too much supply. And even though the problem is currently supply, not demand, there's also a feeling that there's also not enough demand. The global economy is going down, etc. Another thing which was very significant for the pound, but I think reverberated all around the world, is that the United Kingdom, post-Brexit, we had the first PMIs. We had a special preview for that last week. They were terrible, and this shows that uncertainty is still critical, okay? And Mario Draghi, he had also an event, the rate decision last week. He was also seemed tired of everything, was sort of not so optimistic. So, hope you can hear me a little bit better now. Anyway, let's begin with Brexit update, as we call it. Anyway, the PMIs are the worst in 7 years, showing a chance of recession and contraction zone. Other measures of business confidence in the UK do not look good. There's also an uncertainty about people crossing the channel. For example, if someone French, Spanish lives in the UK, the future is uncertain if he can stay there, she can stay there. Same thing goes for Brits living here. That's because the new UK Prime Minister Theresa May is does not guarantee, at this point at least, the future of those people. So this adds also to the general uncertainty about Brexit. Okay, data. Let's talk about recent head figures. So services PMI, as I mentioned, 47.4 in the UK, the lowest in 7 years. Retail sales missed, but they were mostly pre-Brexit. Jobs beat, on the other hand, that was pre-Brexit for May. We had them shine at 4.9%, a fresh low. So not always terrible in the UK, at least not before the Brexit. In the UK, in Germany, we had the ZOO figure was disappointing, but then IFO figure came out better than expected. PMIs came out better than expected. So it's unclear how bad Brexit is for Germany, how bad it is for the continent, at least not according to, there's not a big shock according to business indicators. Okay, US jobless claims, moving to the US, because today we have key US data. Jobless claims were good, 253,000. Existing home sales were good, 5.57 million. Yesterday's new home sales were good, it was 572,000. And also consumer confidence in the US was positive. So US figures are looking positive. Remember that when we talk about the Fed. And Australian inflation was okay, was in line, I think, to write home about, not a terrible disaster. Okay, before we talk about further events, I see here a few questions. So let's address them. So good morning, Ramon. Good morning, Hans. Good morning, Ed. So Ramon asks, hardly have the pleasure of your company these days. Yeah, I'm doing the show now once a week on Wednesdays, but due do tune in to the special coverage of the Fed this evening, and also on the GDP. On Friday, we're having a special coverage, so you're most welcome to join. Ed says, Turkey is the spanner in the works. France has over 5% of all overall exposure to Italian banks. Italian bank debt, and the ECB rallying quietly to give 5 billion more. Yeah, there's ongoing crisis in Turkey. As you remember, there was a coup attempt there, probably by secular parts of the military. It was crashed by Erdogan. He blamed other Islamists. Anyway, big mess. He took advantage of this coup to crack down on all types of opposition, including judges, teachers, academics. It's turning into a dictatorship, and that's at the borders of the EU. After the initial wobble, it doesn't have a big effect on major currencies. Of course, news from Turkey have an effect on the Turkish lira. Regarding Italian bank debt, Monte dei Paschi and other banks are in trouble. Their stress tests released Friday at 10 p.m. here in the Old Continent, 8 GMT in the evening, PM. And there will be some backroom deal, I assume. Lots of trouble today. We had reports from Deutsche Bank, and they showed a profit, but a big fall in revenue. So I think the stress test will be massaged. We know in the past that they didn't tell us anything we didn't know. They didn't shine a light about anything. Okay, but yeah, it's certainly something to watch out for. It can always burst from the back burner to the headline news and impact currencies. At the moment, we do not have an impact on currencies from the Italian banking issues. Let's go back to, thank you for your question. Let's go back to what I've prepared for you for this morning. Let's talk about the upcoming events before we show you the charts. So at 8:30 GMT, after the show, we have UK GDP. It's for the second quarter. It's the preliminary release. Most of the second quarter was pre-Brexit. We might see a slowdown, and 0.4 quarter-over-quarter is expected, but not something terrible. This data, of course, will move the pound, but what's more interesting to see is the data for post-Brexit. That means from June 23rd onwards, basically the third quarter. At 12:30, we have US durable goods orders, key for investment, key for the Federal Reserve that meets later today. And so that's especially the core orders are very important. Less important are the pending home sales. All in all, housing figures have been all of them really positive. This will not make a big difference. Oil inventories at 2:30 GMT. Just read an article earlier this morning that oil inventories should be taken with a grain of salt. But anyway, it does move markets, and oil is slipping down. We'll show you the charts very soon. And the Fed decision at 6 GMT, of course, the main event of the week. It says BIS site has interesting info. Okay, we'll take a look at that. Before we just show you the charts. No, let's move to the charts. Okay, so let's begin with euro dollar, the world's most popular currency pair. Unfortunately, despite the popularity, it doesn't justify the popularity. At least in recent months, we had the Brexit shock, and since then, very much in range. Okay, so on Friday, we did have it fall down to 109.50 something, and then climb back up. This is the Draghi event. Very poor reaction, less than 100 pips. On a decision from the central bank. Draghi used to be a magician. We had a rise to 110.80, fall back down, stabilize, then fall again. Then anyway, 109.60 remains support. I would say 110.50 is now resistance, followed by 111.30 and 111.90, which is strong resistance. Support is the post-Brexit low of 109.10. Yeah, but all in all, as you can see, this is the big Brexit fall. Since then, very much in range. You can say it is leaning lower. Euro dollar is leaning lower. As I said, there's sort of this mellow feeling in markets, this gloom, but not. This is one of the slowest moving pairs. This morning, it's, for instance, up at the time we're speaking 4 pips. Pound dollar, there's lots more action here. Well, we did see some stability. Anyway, currently 131.20, more or less. Relatively stable on the day. We had these moves all the way up to 134.80, then a fall back down. We have conflicting reports regarding the Bank of England's decision. Basically, well, coming from one person, Martin Wheel, he said, I think a week ago, there's no real need to act. He's not so sure. But after the PMI figures, he totally changed his mind. He said it materially impacts his way of thinking, and this weighs on the pound, of course. That's next week, August 4th. Anyway, lines to watch out for are 130.65, 132.50, 133.50, 134.80. Strong support there at 128.50. That's the level that we've seen just before we learned that the Conservative contest is over, that the UK has a new government, and things improved. So that's a key line to watch. It's not the lowest. The lowest in 31 years is 127.90. Okay, anyway, GDP will surely impact. Watch out for 130.65, 132.50. We're currently leaning a bit lower, but not going anywhere fast. Hans asks, could you elaborate on the mellow market? DAX keeps going up every day. Yeah, not only the DAX, I would say, but also S&P. But I'm focusing on currencies. So when I talk about a mellow market, a sort of risk-off atmosphere, that means the yen is relatively strong, although we'll talk about the madness in the yen very soon. And commodity currencies, the euro, the pound, are leaning lower. That's sort of a risk-off. And oil prices are also falling. I certainly agree, not only DAX, also other stock indices are on the move, going up. I think, well, we'll see how the Fed impacts that, if it doesn't dampen the mood also for stocks. When I talk about the market, I'm looking at focusing on currencies, okay? Anyway, let's talk about the yen. I didn't mention it earlier, but we have sheer madness in the yen. 105.65 at the moment, but look at the big moves today. This is a 30-minute chart. Big, crazy things going on in the yen. I believe that the Bank of Japan might steal the show this week from the Federal Reserve. Lots of talk about what's going on in Japan. So we have, since Brexit hit dollar yen quite hard. Lots of safe haven flows to the yen. We had some stability on higher ground above 100. Probably some intervention from the Bank of Japan. Then once again, when things didn't look good, it fell to 100. Why did this move upwards begin? Well, early in July, at the beginning of this month, Japan held elections to the upper house. We had Shinzo Abe, his LDP party, increased its control also of the upper house, and immediately he announced going to do more economic stimulus. And where does the economic stimulus, where does the money for the government come from? Perhaps more printing from the Bank of Japan. And this coincided with the visit of Ben Bernanke, the professor who coined the term helicopter money. He visited Tokyo. He met with Shinzo Abe. He met with Kuroda, the governor of the central bank, and helicopter money was on the table. They denied it, that it was a real option. Yes, no, yes, no. Anyway, we had dollar yen climbing all the way to 105. And then there was talk about stimulus programs. Okay, so we had 10 trillion yen, 20 trillion yen, even 30 trillion yen talked about. Okay, that's when we had the move here to 107.50. Okay, let's adapt this line here. Anyway, but then we had denials of helicopter money. Okay, the government is not going to do so much. And then we began seeing these falls. Especially when we had, I think it was last week, that the BBC published an interview with Kuroda, and he said that helicopter money is not possible, not an option, totally denying it. But then the BBC reminded us that this interview was actually recorded a month ago. So anyway, This morning, long story short, this morning we heard reports from various Japanese agencies, news agencies, that the government is indeed planning to spend a lot of money, perhaps 28 trillion yen, and this weekend, if the government spends more money, it takes more money from the Bank of Japan, and this means more money printing, lower value of the yen. But remember, there are so many rumors, that's why we're seeing these crazy moves right here. Anyway, support 105, resistance 106.40, or maybe a bit higher now, and higher resistance 107.05. Sorry, 107.50. Okay, so crazy days in the yen, significant movements in the pound, not so much in euro dollar. Okay, Canadian dollar, one of my favorites. I know it's overlooked by many. The pair dollar CAD is going up because of falling oil prices. Very easy to see that. This is the trend in dollar CAD going hand in hand with the fall down in oil prices. Okay, so too much supply, oil inventories show that. Less production problems from Nigeria, less demand. I mean, at least in the United States in the driving season. All this pushed price of oil back to levels last seen, well, I think a few months ago. Let me give you a better approximation. So we're in the lowest levels since April. Okay, so it's 3-month low. Usually this season shows higher demand. Lower oil prices currently at 42.76 means weaker Canadian dollar. Not a collapse, but a gradual move to the upside. Support 42.36 for oil. 43.25 is resistance at the moment. Dollar CAD currently 132, just below this line. 132.20, well, it used to be a good line, but not anymore. We have to update the chart. So it's 132.40 as resistance, 131.40 as support. High resistance 133.10. Aussie dollar. Today we had inflation figures from Australia. They came actually quite well, 0.4 quarter over quarter, and the trimmed mean figure, which is the core CPI in Australian terms, it came out better than expected, 0.5. But as I said, the atmosphere in markets is not so positive. We heard last week from the Reserve Bank of Australia that they are thinking of cutting rates. It's unclear, as CPI figures are not that terrible, but Australian dollar is somewhat leaning lower. I would have expected it to bounce further up. We had a small spike and then fall down. 74.40 support, 75 some kind of resistance, followed by 76. Okay, that's a popular currency pair as well, and well, for good reasons. Kiwi dollar also here, we're expecting a rate cut. We had weak inflation figures in New Zealand, hints about rate cut from the central bank. They had a special report. So we're off the lows. 69.50 works very well as support, but not going anywhere fast, hugging the 70 level. 71.40 works as resistance. Let's talk about a few crosses. Well, talk about dollar Swiss franc. Those of you that came regulars in the show know I do not like the Swiss franc because of the extreme and excessive interventions by the Swiss National Bank. Currently 99.34, 99 is support, 98 further support. The line of parity is an obvious line of resistance. Euro Swiss rising up, perhaps intervention by the S&B, perhaps not. Anyway, we never see big moves here, just higher within the range. Very slow movements here. 110 remains resistance. I would say 107.60 is support. Euro pound, much more interesting cross. Of course, it shot up on Brexit. We reached very high ground. Since then, the pound recovered. The euro sort of grinds very, very, very slowly to the downside. So we have euro pound a bit lower than the immediate post-Brexit levels. 83.50 support, 84.50 is resistance. No, well, let's update this. Let's make it 84.30. Hi, Cyril. Hi, everybody. Let's continue. Euro pound, euro yen. Okay, 116.25 also here. The Brexit shock sent it lower. We're totally different levels. And of course, now it's moving mostly according to the yen, because the euro is not moving too much. 116.25 at the moment. 114.50 I would say is support. 118.50 is resistance. Moves here are a bit crazy, but this is where there's more madness. Pound yen, the dragon, up 1% today. Today it's led by the yen, but in other cases the pound is very active here, so it's not a one-sided move. Low support 128.50, high resistance I would say 140. No, this would be a better approximation here. 143.50. Currently at 138, the level that it did hug in the past. 138. No, I would say 140 is some kind of resistance. Anyway, this is a mad pair. Lots of pips to be lost and to be made here. Trade with care. Remember, both these are the most volatile currencies in the past month or so because of Brexit and the speculation. So we have the biggest movements here. Sometimes the yen and the pound are strengthening at the same time, and then we see stability, but sometimes they go in different directions. So that's when we have madness. Okay, so we covered all the charts. Let's take another look at dollar yen. Well, didn't change much. Okay, so we covered the events we had so far, the news, the charts. We talked also about events today. Let's talk about other events this week, and then we'll move to our special previews, okay? So our special previews for today are the Fed, the GDP, and US elections. Anyway, before that, up next this week, we have tomorrow, relatively calmer day than today with the Fed. Have the German CPI tomorrow. It's not as important because it comes after the ECB decision. Nevertheless, it's a key figure. We also have US jobless claims, which have been really good in recent weeks. The 4-week moving average is at the 250 handle, so that's something to watch out for. And Friday we have the big event, Japanese rate decision. I have no idea what's going on. Well, sorry, I do have some thoughts about that. I think the Bank of Japan will not introduce helicopter money, will not print outright money just yet because of the US elections coming up. So they won't go to a move that will aggravate the Americans and also their neighbors, Chinese, the world's #1 and #2 economies. So I think they will add more stimulus, but just a bit, that it will eventually turn into a disappointment. And this disappointment from the Bank of Japan will lead to a stronger yen and a stronger dollar yen. Okay, we might have stimulus from the government next week, but for this week from the Bank of Japan, I expect a disappointment. I mean, markets are hungry for money printing, for basically, I think I mentioned this, one of the ideas to do helicopter money is that the government will issue bonds without a maturity date and will not sell them to the market, just immediately sell them to the Bank of Japan, basically printing money, using this money either to hand money, coupons, for example, to the hands of consumers so they'll buy more and stimulate the economy, or that the government will invest this in infrastructure projects. I mean, normal government spending, okay? Anyway, don't think this will happen. The Bank of Japan is already doing a lot. Another cut of negative rates will not do much. I think there will be a disappointment this week, but you never know. Japan did surprise us in the past. So that's the big event for Friday, but it's not the only one. We have the European initial GDP numbers. As far as I know, not coming out from Germany, but from France and from Spain. And we have the all-around European figure. So it is important enough for the euro. I think it will move the euro. And US GDP, we'll talk about that soon. Also GDP from Canada. So it's GDP day on Friday. And at 8 p.m. GMT, late at night, just as New York closes, we have the European stress tests. Given the past, I do not expect any revelations there. We will not learn something we do not know. It serves a bit as a deadline for the Italian government, Germans, Europeans, the European Commission to close a deal to find some recapitalization for Monte dei Paschi and other banks to resolve these issues. But as we know from Greece and from other places, deadlines are meant to be broken. So I think they'll just tell us there are problems there, nothing we do not know, and these problems will continue going on. I think that in Italy, well, just a quick talk about Monte dei Paschi, high level of bad loans. According to EU rules, the bondholders should bail them out. The Italian government doesn't want this because most bondholders are, retail investors. This will anger the population with the government. So Italy wants to use, the Italian government wants to use the government money, which is also taxpayer money, which is only supposed to be used in extreme cases. Is this an extreme case or not? There are lots of politics there. Italy has been a bit of rebelling, I would say, recently against austerity. Also, Spain is doing the same. So maybe there is some element of punishment there. I don't know. Anyway, I think they'll kick the can down the road. Okay, that could be an interesting event on Friday. Will impact markets only on Monday because it basically comes after markets have closed. Okay, so these are the events. So Friday is a very busy day, starting from Japan, continuing to Europe, North America, and then another closure in Europe. Okay, before we move on, good morning, Luca. Rumors have it Monte dei Paschi will issue spaghetti bonds, swapping equity for pasta vouchers. Okay, I'm sure it'll be high quality Italian pasta. If I had that, maybe I would have agreed. So yeah, I'm sure there'll be so many rumors, not only about spaghetti, but also about mechanisms for recapitalization. Eventually, somebody will pay the price and it'll be painful, I'm afraid. Anyway, it says stress test just to keep Joe public in false sense of security. Yeah. In the past, the stress test didn't foresee the collapse of Irish banks, didn't foresee other problems. They're basically useless. They lost a lot of credibility. And maybe, the pasta will be contaminated with GMO wheat. Yeah. So anyway, thanks for your comments. I guess we're all a bit cynical about European politics. We'll soon talk also about US politics. Okay, so now let's move to our special previews that I've prepared for you. This is the preview for the Fed decision for July 27th. That's today. Let's start with the obvious. No change is expected. Rates are expected to stay unchanged at the range between 0.25 to 0.50. Basically, it's a story of the US economy versus global worries. Or if you wish, is the Fed really data dependent, or do they have many other things in mind? If you look at recent data from the United States, it looks good, not perfect. There are some disappointments, but housing sector, all the figures have been positive. New home sales, existing home sales, building approvals, everything has been positive. There's a good correlation between housing and the rest of the economy. Retail sales. The United States economy is all about consumption. And retail sales have been consistently strong in the past few months. That's good news, okay? Jobless claims have been down. After talking about jobs, the recent NFP report showed a bounce. Sure, this can also be a one-off, but at least the report for June showed that the previous disappointing report for May was a one-off, and we can be a bit optimistic. So if the Fed is data dependent, it should maybe raise rates now, or at least tell us that if things continue in the same direction, they will raise rates in September, okay? That's the data dependent, that's the local economy. But they have other considerations. One of them is the US elections. Raising rates now, and well, not now, not today. Raising rates in September, 2 months before the election, 6 weeks before the elections, doesn't look good, could trigger a lot of criticism, okay, especially from the Republican side, but they could also blame, the Democrats can blame them for hurting the economy and hurting their chances of basically being reelected. So the Fed will likely not intervene, okay? So That's another consideration. Another consideration not to do anything is, of course, Brexit. Lots of uncertainty. The signs that we do have from Brexit show, chance of a recession in the UK could impact Europe, and the global economy has already been fragile. Of course, worries about China are always there. So I believe my assessment is that there will be some acknowledgement of the improving economy, but no smoking gun, no hint of rate hike in September. And my assessment at the moment is that we'll have a rate hike in December after the US elections, assuming that Brexit is not that terrible, and assuming that the US economy continues at its current pace, okay? Things to watch out for the statement. I'll just mention once again, I didn't mention this, there's only a statement, no rate hike expected, no new forecasts, no press conference by Janet Yellen. Something again to watch out for is our live coverage with Valeria Bednarik, Mauricio Carrillo, and myself. Anyway, regarding specifically the data, the Fed has two mandates. Inflation, very, very steady, not rising, but not falling. Wages in the last report have been stable. I mean, ticked up from 2.5 to 2.6% year over year. That's also an inflation measure that's okay, that's steady. I mean, positively steady, not boring. The bounce in jobs, the Fed could be less worried than it was in June, okay? Perhaps they could also be cautious, but they should be less worried, okay? As again, no hint for a rate hike in September. They might, there is this annual meeting in Jackson Hole, Wyoming. Looks like a very beautiful place in the middle of the United States. They have the Kansas City Symposium there. In the past, Ben Bernanke used this meeting to hint about policy moves. So perhaps it happens at the end of August. So Janet Yellen could use this to hint about a move in September. I am very skeptical. Why? Not because the US economy doesn't look good, but because the Fed is dovish. They always are on the side of caution. So to conclude, I do not expect any move I do not expect a move in the rates today. I expect the Fed to be dovish. They could acknowledge the improvement, but all in all, they will try not to rock the boat. So I believe the current trend is a slightly stronger US dollar. You could see a bit more of that, but not too much. If they do hint about rate hike in September, of course, the dollar is going to shoot higher. If they continue painting a gloomy and cautious picture like they did in June, the dollar will fall. The bias is a stronger dollar, but the Fed is dovish. All in all, I think things will be balanced, okay? Comments, questions here. Here's a smiley. It says they would never raise rates prior to elections. It's a safe bet they won't. Yeah, I agree. Lucas says as the Fed chickens out, meet S&P 2200. Yeah, I would say about the S&P that for stock markets, the perfect scenario is that the Fed paints, on one hand, a rosy picture of the US economy. Things are looking good, which is, well, supports business confidence. On the other hand, they're not in any rush to raise rates. That's the win-win scenario for stocks, okay? But the lose-lose scenario is the economy doesn't look so good, but we're going to raise rates anyway. Of course, this is off the cards. I think they'll, if the Fed chickens out, S&P 20, I say it's a reasonable assessment. It says also the Fed won't raise rates prior to UK not signing Brexit. I'm not sure about signing Brexit. It'll take a long time, but I don't think they actually have to wait for Article 50 to be triggered. I do expect more economic data and more clarity, okay? So this might come in the coming months, even though Article 50 is likely, according to UK Prime Minister Theresa May, will not be triggered before the end of the year. Okay, so thanks for the comments. That's our Fed preview. Now, preview for GDP, but the focus will be more on in general, what is GDP, especially for the United States? So here goes. This is our US GDP preview, US GDP explanation. Okay, explain. What is GDP? That's gross domestic product, basically how much the economy is worth. The basic calculation is consumption in the United States. It's a huge part. It's about 70% of the economy. Okay, immediate consumption, investment, more long-term expenditure, government spending, and the value of exports minus imports. This is sort of the classic definition. The formula, Y, I mean the total output is C plus I plus G plus X minus M. If you ever see that, anyway, here it is. What we're interested in is not the actual GDP, which is about 16, 17 trillion, but the change, the growth rate, okay? How much has it changed since last time? And here, things can be a bit confusing because calculations are different. In the United States, GDP is measured in annualized terms. That means it's a change in the output this quarter as if it were the full year. So for this month, for this quarter, it's a quarterly figure in the United States, like in most places. We're expecting an annualized figure of 2.6% on Friday, okay? In places like the UK, and we have the UK figure released today, this would mean 0.6 quarter over quarter. It's more or less a multiplication by 4, okay? This is not a year over year figure, like in the one released for China, for example, not the change between Q2 2016 to Q2 2015, but rather the figure this quarter multiplied by 4, okay? More characteristics of the GDP in the United States. In the United States, as you probably know, they really love statistics, which makes things more fun, but sometimes more confusing. It's released 3 times. There are always big revisions. The first release is around the FOMC meeting. Really, this is something to watch out for. So if we have the GDP released this Friday, we have the FOMC also this week. The Fed will have, this evening, they will have the GDP figures, okay? So watch out for, forgot to mention it in the previous preview, that if you see a hawkish statement from the Fed, it could mean GDP is good. If you see a more bearish statement, it could mean that GDP is weak. Anyway, the first release is the most important one, has the biggest impact on markets. This one is released alongside the Fed decision that does not have a press conference. That means in January, April, July, and October. Okay, it's always this way. And then in the following month, we have another revision. Okay, we have at the end of August, for example, we have the first revision or the second release, and then the third and final just before the next quarter ends. That means in this case, we'll have at the end of September, at the end of Q3, the final figure for Q2. But note that this specific release in July features a multi-year revision, okay? That means they're taking in once a year, they look back at a few years backwards, try to understand where they went wrong and do some multi-year revisions. This could add to the confusion. Usually these revisions are not huge, but they add to confusion, okay? Now, let's dive into GDP. GDP, we talked about how it's released and what it means. In the US, there is good GDP and bad GDP. Good growth vs bad growth, okay? What's good? The good, bad, and the ugly. So good GDP is consumption. When people are buying more stuff, that means they are more confident. And that's also the biggest part of the economy. So that's something we should look out for, personal consumption. Another figure to watch out for, even though it's much smaller in the United States compared to Germany, for example, or China, exports. Basically, the more a country exports, that means there's demand from other places in the world. And this could turn into a virtuous effect. Okay, so that's also good growth. Third good growth is investment. More investments, more hope for the future. If a company builds a new factory or employs more people, or I don't know, things like that, it's also has a virtuous effect, hopes for the future. Of course, when these three figures fall, it's all bad news. It's a vicious cycle, a vicious effect, not a virtuous one, okay? What kind of growth is bad growth, okay? When we have government, more government investment, that's seen as temporary, and that's also frowned upon in the US. The US is more based on of course, private sector, especially in comparison to France, for example. So any rise in government spending can be stopped later on by Congress, or anyway, it can be temporary, and it's not the right kind of growth. Another bad kind of growth is inventories. Basically, what goes up must come down. So if there is a build in inventories, if storage is filled up, that means that in the next quarter, it could be depleted, and the other way around. So if we have relatively low growth, but because of a fall in inventories, it's not such bad news, okay? So same goes for consumption, and if we have good growth, but consumption is weak, not led by consumption, it's not such good news, okay? Of course, the headline figure is the most important one, but then there is a second reaction that markets look into the components of growth, okay? And let's continue. Yeah, in general, these are the latest figures to give you some proportions about US growth. Since 2013, we're not going all the way back to the crisis. Things look a bit crazy, okay? I mean, relatively volatile. So we have begins with, in this chart, 1.1 in July 2013, reaching a peak, well, falling to contraction early in 2014. I mean, a chance of a recession. Recession is 2 consecutive quarters of negative growth. It means contraction, and that's officially a recession. We had only 1 quarter, and then we had a big bounce, 4.6, 4.3, and then also had a slowdown, a very poor quarter early in 2015, then a bounce. Last 2 quarters were quite poor, 1.4 and 1.1, and now we're expecting 2.6, a bounce back in growth. As I said, US data looks good. So we are seeing lots of volatility here, but once we look at annualized growth, sorry, not annualized. That was annualized what I showed you beforehand. This is year over year. If we look at year over year, the changes are not that big, okay? So, okay, in 2013, it wasn't that strong, and gradually 2.5, 1.7, 2.6, 2.9, and recently around 2%, 2.1. Basically, what we are seeing here is what Christine Lagarde called the new mediocre, okay? 2.5% annualized growth, year-over-year growth is not that good, okay? Anyway, for this Friday, we're expecting 2.6, a big bounce. As I said, retail sales look good, other figures look good. But the first release tends to have the biggest chance of surprise. That means I will say in general that if we have under 2% annualized growth, it's bad news for the US economy and for the global economy. And if we have above 3%, it's an acceleration, it's good news. I am with market expectations, expecting this new mediocre of 2.5 or something like that, maybe closer to 2%, maybe a bit of a disappointment, but not, anyway, nothing earth-shattering. GDP figures have become a bit boring. Maybe boring is better because we don't have a boom and then we don't have a bust, but anyway, it's not excellent stuff. Questions here? If the Fed, okay. Yeah, Lucas says if the Fed is dovish and BOJ under-delivers dollar-yen back to 100, yes, that's certainly possible. I would say the Fed will be cautiously dovish and the BOJ under-delivers. It's something that I see as more certain. Yeah, we could see a collapse because the recent rise in dollar-yen has been fueled by expectations of big stimulus in Japan, and there is a good chance of a disappointment in Japan. Okay, I will leave the the Fed will rock markets, but they'll leave the bigger show for the REN for the Bank of Japan. It says problem is GDP is calculated with different formulas used by different countries, so it's not comparable really. China changed formulas a few times in the last years. Yeah, I agree. I would mention that here in Spain, a few years ago, they added illegal activities such as prostitution and drugs to the calculation. As these are illegal activities and nobody pays taxes on them, I don't know how they're measured. It's an estimation. But anyway, this makes GDP look bigger. Clearly, these are activities that happen. You can't deny them, and they are economic activities. But anyway, yeah, it's hard to compare. What we should compare is not levels of growth in different countries, but within the countries. Is the trend improving or deteriorating? Are we in growth or in a recession? Is growth accelerating or decelerating? These are more important figures to look out for. Okay, let's continue to the next preview. Well, sort of more an update and preview, a bit shorter. So this is an update on the US elections. Things are becoming more interesting. For political junkies, news junkies, addicts, these are huge weeks. We had the Republican National Convention. This ended on, last week, and now we have the Democratic National Convention underway this week. These are 4-day events of basically free media coverage for the big parties, so it gains lots of attention, lots of talks. I'm listening to 2 podcasts to follow this, the 538 one and the NPR one. I recommend them if you're interested, and of course, there's news everywhere. But what's going on? So after the Republican National Convention, after Trump's speech, polls show a bounce for Trump. Okay, so let me show you the recent, the estimations that I use from 538. Nate Silver, it's not, everything can be argued, but this is sort of an estimation. Anyway, the chances of Clinton winning fell to about, 50-50, 52.4 against 47.5 for Donald Trump. Okay, you can look here at the trend. Clinton had a much bigger chance of winning, close to 80%, and recently the gap has been closed. Now, you can say this is normal. I mean, if you listen to all these experts, they say always the parties have a post-convention jump. Okay, so now it was the Republicans' turn to enjoy good coverage and rise in the polls, and now the Democrats will take it back, and we have to wait until these effects will calm down. But it can be something bigger. It can be a more material change. Hillary Clinton's email scandals, Trump maybe becoming more presidential, although he was very gloomy. Anyway, what does it mean for markets in general? These are 2 very different candidates. Hillary Clinton, in the public eye for 25 years or so, First Lady, Senator, Secretary of State, always in the limelight, good and bad, a bit gray, not very exciting, very mainstream, okay? Gets money from Wall Street, has been in all corridors of government, certainly experienced, certainly wise, but some, of course, her judgment is also questioned. Anyway, trying to be a bit abstract here. Donald Trump, on the other hand, very colorful figure, stoking fear, lying a lot. I mean, finally the media begins fact-checking him, but he talks to emotions, and for markets, he is theoretically anti-trade. Okay, now also Clinton moved a bit to the anti-trade camp, influenced by Bernie Sanders, but the big expectation is that she won't differ a lot from Barack Obama on a pro-trade atmosphere. Anyway, watch out for the post-DNC polls. DNC is Democratic National Convention. That means the polls that will come out early next week to see if there is a bounce. Markets usually prefer Republicans. Republicans are more pro-market. But in this case, Donald Trump is a wild card, and Clinton is very, very known. So I believe they prefer the more of More of the devil we know. Anyway, these are happier days between the couple. Here they are, Donald Trump, Hillary Clinton, Bill Clinton, and Melania Trump in Trump's wedding back in 2005. Now they're not such a big happy family anymore. Okay. Yeah. So that's an update on elections. We're about 100 days before the elections. I believe that we'll begin seeing some impact on markets relatively soon. I'm just giving you an update and a preview. Okay, so that concludes our political update. Now let's do a preview, as we always do, for the next week. First of all, it's a busy one. It's the first week of August. I'll mention that August, contrary to popular belief, is an exciting month in markets. Markets are not on vacation. Last year, we had the collapse of the Chinese stock market while I was on vacation, and I missed out on that. In 2011, S&P downgraded the credit rating of the United States, and markets went crazy. Beginning of August 1st to August 5th, it's a busy week, and I think markets will move. First of all, on Monday, we have the Chinese PMIs. These are still important. China has been out of the limelight because of Brexit, because of other stuff. They took advantage of this to a bit, I would say, devalue their currency. Anyway, let's see how they're doing with the PMIs, especially the independent Caixin manufacturing PMI. Also, watch out for the UK final manufacturing PMI. We had the special preliminary ones last week. Let's see if things change. And we have the first ISM manufacturing PMI, the first hint for the NFP coming out on Monday. So it's, and also we have the reaction to the stress test in Europe, the bank stress tests. So it'll be, I'm sure, a relatively busy Monday. Usually Mondays are a bit more light. On Tuesday, we have the Australian rate decision. There is a cut on the cards, but with recent inflation figures, maybe not so fast. Let's see. I believe that it's more of a coin toss. That means rate cut, Aussie falls. No rate cut, Aussie rises. Okay. UK construction PMI, also important, but it's the third in line. On Wednesday, New Zealand employment data released only once per quarter should have a big impact on the kiwi. UK services PMI, this is the final release. Will we see a correction? Will the final figures be better than the initial ones, and then the pound can bounce? Or not? Will they confirm? So that's a big event also for the Bank of England. Big hints for the NFP come on Wednesday as well. The ADP non-farm payrolls and the ISM non-manufacturing PMI, the services sector, much bigger in the United States, like in the UK, bigger than manufacturing. So it's NFP hint day as well. And on Thursday, we have the BOE rate decision. Will they finally act? 2 weeks ago, they told us that they want to see more data. The data is out. It doesn't look good. Will they cut rates from 0.5 to 0.25? Will they add more 50 billion more QE? Will they hint they'll do more in the future? Or will they say, basically, we're doing a lot, the government should do more? That is a huge, huge, huge event for the British pound, and also other currencies will be impacted, especially the euro. Okay, so that's one of the biggest events of the week, of course. The decision of the Bank of England, August 4th. Okay, and on Friday, of course, it's NFP day, US non-farm payrolls. Well, after this time, we have a full build. So it, of course, moves markets, and also for those trading the loonie, we have the Canadian jobs report. So that's a preview for next week's events. Non-farm payrolls and the Bank of England are the key events at the end of the week, but both of them have buildups with the ISM figures for the US and the PMI markets PMIs from the UK. So these are the main currencies to watch, but we'll also have reactions to the Bank of Japan, reactions to the stress tests in Europe, and well, and also again, watch out for political news. Political polls coming out Monday afternoon here in Europe, Monday morning in the United States, which will tell us if Clinton bounced, which is something that usually happens after the Democratic convention, or not. And then markets might panic a bit more. Okay, so before I reach the wrap-up for today's long show. I see another question here. Lucas says, tell Syracuse still looking for a major dollar crash, thinking we may be developing. 8 head and shoulders pattern, but still time needed for symmetry on right shoulder. Okay, thanks, Luca. Let's share the chart with everybody here. Yeah. Okay, thanks, Luca, for the chart. This line of resistance might provide reason to sell and fall back to the bottom of the range. Let's see. Yeah. Good. Glad to see you collaborating with each other. Okay, so this is the wrap-up for the live market open for the show. Basically, markets are a bit more mellow, some gloom from Trump, falling oil prices, Brexit uncertainty after the PMIs, and Draghi looks a bit tired. That means the yen looks a bit stronger, and the dollar also, and pound basically not a bit of a more worried atmosphere. Again, not in stocks, but more in currencies. Recent data, as mentioned, in the UK doesn't look good.
1 minute before the release. Stand by.
Sorry for that. Lots of uncertainty regarding Brexit. It's something going on. We had some calm, but it seems to be over. Data in Europe, it looks better. In the UK, not so good. In the US, it looks really good. Today, we have the UK GDP in about half an hour, but it's a bit outdated. Durable goods orders, key for US investment. And the Fed decision, remember, Fed, on one hand, things are looking better in the United States, but global economy does not look so optimistic. Let's see how they balance it. I expect them to be relatively dovish, not provide a hint for a rate cut in September. Keep the door open, of course, but nothing, and acknowledge some improvement, but not really provide optimism. Let's take a look, a quick look. Well, sorry, I'll mention that the Fed decision, we might have a hint for GDP on Friday. GDP on Friday expected to show 2.6% annualized growth rate. It's the first release in the United States. It's expected to show a bounce after 2 relatively weak quarters. Also on Friday, watch out for Big Friday, Japanese rate decision. I expect a disappointment, some stimulus, but not enough for the market's hunger. And late in the day, the European stress tests for banks, and they'll probably be a bit whitewashing. Okay, anyway, so that's this week. Anyway, let's look at the charts. Euro dollar extremely stable at 110, 109.60, 110, 110.50. These are the lines of the current very frustrating range. Also, pound dollar fell asleep just a bit, 130.60 to 132.50. Dollar yen extreme madness this morning here, very choppy. 105 is some kind of support, followed by 104, and on the top side 106.40 and 107.50. Dollar CAD, Canadian dollar, slipping with oil prices, so 131.85 currently, 132.40 resistance, 131.40 support. Aussie dollar, despite better than expected, slightly better than expected inflation figures, not going anywhere fast, under 75, 74.40, and 76 are lines to watch out for. And the kiwi hugging the 70 level, waiting for data mostly next week. Okay, so I think that's the wrap up for today. As always, you're welcome to watch the full show, replay the special previews, and everything else. Before we go, I see more questions. Luke asks, what's up with Spanish politics? Still no government. Yeah, still no government. The king, Felipe VI, is consulting the political parties, and he's expected to ask Mariano Rajoy, the leader of the center-right Partido Popular, to lead the new government, to continue. He's the prime minister, to lead the new government. He doesn't have enough support. He might get support from a bit from the inside, from Ciudadanos, and from the outside, perhaps even from Catalan, one Catalan party, and perhaps other support, and form a new government. but a minority government. That's sort of the baseline scenario. But there's also a chance of a third round of elections. So things are moving very slowly in Spanish politics. On one hand, they counted the votes very quickly. Within 4 hours, we had full results. On the other hand, forming a new government, political talks, especially now when it's so hot here in the summer, it's going on very slowly. Also a story on the back burner to watch out for. I haven't been talking about it because it has become boring and politics are much more interesting in the US and in the UK. Anyway, that's sort of the update. Maybe next week we'll have some news. I think there's a debate in Parliament next week, but don't hold your breath. Okay. Anyway, that's the show for today. Very long show, lots of previews, Fed, GDP next week, and we had the wrap up, of course. Thank you very much, everybody, for coming, for the great questions. I wish everybody a safe and successful day, the rest of the week and next week as well. We'll be here for the live coverage this evening. Do tune in. I think it begins at about 5:30 GMT, half an hour before the Fed decision. And also on Friday, watch out for the GDP coverage. Remember, the first release is more important. And yeah, and you're welcome to visit FX Read, Forex Crunch. And that's it for today. Thank you, everybody, for coming, and see you soon. Ciao. Bye-bye.